Well, good afternoon, everybody. Welcome back to Bull Sessions. Ken and I are very grateful that you've given us a couple of weeks of hiatus, and we both did take the opportunity to get some vacation, and so did Matt. So the three of us are back and exhausted from the type of things that you subject yourself to during vacation, but it's all good. So my name is Mark Robertson. I am joined here by my dear colleague, Ken Kavula. Good afternoon, Ken. I
Well,
see
good
sunshine.
afternoon, Mark, but speak for yourself on this running around in 90-degree weather. I refuse to do anything like that anymore. So,
Yeah, it was warm in northern Michigan for sure, and dare I say hot. And Kim is traveling, but Matt Spielman is also with us here today. Good afternoon, Matt.
Good afternoon.
And you made it back safely from your camping adventure?
Down the river. We went tubing on the Kamala.
Excellent. Well, that Ken, that is also a fairly a high level of exertion. So I
it's
suppose,
also not on my to-do list,
and
Mark.
it's not on your list either, huh?
No,
It's on the
my
way to
wife,
San Antonio. I'm just saying.
my wife and I prefer to do nice strolling through the streets of a small town. We enjoyed that very much. But strolling, that's about as much exercise as I'm willing to get when it's 95.
There
So,
you go. Well, we are getting closer and closer to San Antonio. One of these days, we're going to get there without a doubt. So, again, we're kicking off what is basically our sixth year of doing this, Ken. It's another one of those things where we just started doing it and investigating and exploring topics of interest to ourselves and our community of investors, and it's been a whole lot of fun. I brought back I believe that's a Norway or one of the Scandinavian company or country communities there in the background. And we do like the tagline that we do attempt to make successful investing unimaginably imaginable. And of course, the bull is there dancing too. And again, we look forward to continuing this as long as you guys are hanging out with us.
I want to remind you, Mark, how excited we were the very first bull session when our audience count went over 20. So we were very pleased at that first session to get more than 20 people at it. So I congratulate the audience for sticking with us, and this has been a lot of fun. And I never thought we'd be doing it for this long a time, but as long as it's enjoyable, let's keep it going.
Yeah, and frankly, I'm not just uh, buttering up the audience whatsoever. You guys take us places that we wouldn't normally go, and we learn all the time. We hadn't heard of a thing called JEPI until you guys took us there. JEPI for the ticker for anybody who wants to dig into it. But we do that with one of our demonstration portfolios, and there's just a whole number of comparable type topics that we have visited, including that life cycle concept and early stage investing and all that. So we look forward to continuing to explore that kind of stuff. Today we will take a look at the Groundhog Challenge. It literally is halfway through. We're 3 days into the second half, so there still is a lot of time left. I apparently need a lot of time, and we're going to hope for the best for the rest of the year. We will talk briefly about the rule breaker epilogue that David Gardner has written, and that led me to a Motley Fool ETF that we needed to take a closer look at. So we'll go there, and if you guys have any questions, we'll try to keep up with them. Here's our standard disclaimer. Basically, what it boils down to is you make the decisions about all this stuff. Do your own homework, understand it, do what makes sense to you. Make your own decisions about this stuff. If you'd like copies of these slides, or if you have questions or suggestions for future topics, our two email addresses are there at the bottom of the page.
22 seconds, Mark. Okay.
New record. All right,
A new record.
because I couldn't wait to get to this. Okay, well, on the left side of the page, again, the audience can share what they would prefer, but which one of these tattoos would you like to get? With the national convention in April in Chicago, I feel like we should have a tattoo artist there, Ken, and
Well,
be dealing No, I'm not getting a
I
tattoo.
I haven't been able to figure out tattoos since one appeared on my daughter's arms, Mark, and I'm never going to be able to figure it out. So I'm just a stodgy old boomer that doesn't understand the whole concept. So
I'm with you there. But speaking of getting tattooed, how's that for a segue? Um, wow. While the market's been doing extremely well, Portillo's hasn't. And what's kind of fascinating is they just barely missed their quarterly sales revenues for the trailing 3 months, by not that much, like 3%, which maybe some of you think is a lot, but I don't. But to go from $12 to $8 virtually overnight, that's not fun. And for when Kevin Gologlu listens to this, to the YouTube version of this, yes, Kevin, $8 is below my cost basis. So yeah, they apparently missed a little bit on the sales, and they're just getting, dare I say, tattooed. All right, enough on that bleak story.
I will note, Mark, that the relative strength has now moved below the place where we're supposed to maybe be interested in purchasing the stock. So that's the first time it's done that. It might have touched there a couple years ago, or a couple months ago, back in April, but it's been all the way since probably right at the new year or right before the new year, with the last time it went below that relative strength index. So maybe that goes to show how valuable this particular indicator is.
Well, if you bought back in if you bought back in December of 2024, you could have sold it for almost 2 times its
Well,
value
yeah,
just a few
if
months
you
later.
if you would have wanted to sell 2 months into an upward swing, I'm not sure about that,
Well,
but
if Steve Emmerich has taunted me here, I'm actually tempted to take my handful of shares and double down at 8. And my it's an accumulation no, it really, I don't know. I don't know what it
so
is.
so dollar cost averaging would average down the cost of all the shares then? Is that what you're saying?
Yeah.
Okay.
So Steve, it'll be your fault if I buy it and it continues further south. All right. Just some stuff going on this week. First picture on the left, ARCLS did report earnings yesterday. Kim's not here to give the full report, but revenues were good. They added a couple new key personnel. They lost their CFO as of August 1st, and that's kind of uncomfortable for shareholders, but the stock is up some 25% over the last couple of days. So ARCLS is behaving pretty well. It is a fairly large component in the roundtable, so even you can have to at least celebrate that.
Well, I was going to say something really, really, really nasty, but I won't. Okay. Uh, more power to the folks that hold ARCLS with a cost basis under $1. So
Which
see
is
what happens.
some of our roundtable shares are under $1.
I'm just not going to point out what you could have done if you would have invested in the nuclear stuff a year ago. So I won't say anything about that.
Okay. Well, I did though. I did take you up on SMR, so good stuff.
Okay, but you missed ARCLO. All right.
I did. I did. Okay, well, Burt Lake is the sunset picture that you see up there next to the Align Technology logo. And Stryker's the current update that we'll probably take a look at in greater detail. So our family was up on the shores of Burt Lake having a good time. And then I don't have a picture of Ken and Natalie staring off longingly into the mountains of Tennessee, but that's one of us from a few years ago. So there's your Tennessee mountain picture.
All right.
Let's keep going. All right, what did the market decide to do during our 2 weeks off? It fluctuated. It fluctuated a lot on Friday. It fluctuated a lot more on Monday, yesterday. So,
Well, folks, I told Mark in the green room that I had great discipline on Thursday afternoon, all of Friday, all of Saturday, and all of Sunday, not looking at my computer in any way, shape, or form, not knowing what the market was doing, nothing. I came back yesterday and got everything all ready to go, and it was a great day in the market, and I thought, well, my portfolios will really be zooming along today, and I opened them up, and they were exactly where they were when I left. So I didn't have the angst of the drop, and I didn't get the joy of the regain happening. It was just nice business as usual for my portfolios. So Mark, that's what can happen if you can just divorce yourself from it from a week, you know?
oh yeah, I definitely didn't even turn my phone on for a couple days, so I know what you're talking about. By the way, all of the gap in that last bar on the right between that and the red line, that happened in one day. And I suspect that today it's been put back a little bit over the last couple of days. So yeah, that fluctuation between the yellow dots for value line and the blue dots for manifest investing projected annual return, that all basically came in one day, the last day of last week. And but the market continues to be pretty fairly valued in general. That doesn't mean there aren't some buying opportunities out there. And we'll call it 9% for now. 9% returns.
Sounds good. And
Forecast.
we've been calling it 9 to 11 for the last 100 years. So that's still stays right in that nice tight range. That's good for us.
Pretty comfortable stuff. All right. So here's a look. We haven't looked at this in a while. Here's our performance perspectives. This is an extremely powerful chart. Stare at it until you get it and then share it with friends and family. The point of this chart is first, yeah, you can invest in an index. There's nothing wrong with doing that, but that basically consigns you to this part of the chart. That's our index central. And there's nothing wrong with these returns. Those are good returns. But for some people that are a bit more adventurous, like all of you that are here with us here today, all of the companies listed here are in our top 40. They actually are our top 10 most widely followed companies. Pretty much true if you use either the Better Investing Top 100 or the Manifest 40. So you see a series of names, 8 of which that have performed pretty well, 2 that haven't done very well. And that's the rule of 5, basically coming to life over a 10-year time frame. But what we love to point out is those numbers up at the top are more than just noticeable. They are extremely powerful over the long term in terms of what they can do to your portfolio balance. So Tin Cup continues to truck along at a decent 6.9% outperformance to the market, the Wilshire 5000. The round table continues to slip a little bit, but the absolute return is hanging in there at approximately 16% over the trailing 16 years. And that's not all bad. We hope to see that number creep back up here shortly. By the way, Ken Ardellix is helping, at least for today. But the Buttonwood Bulls, Ken made a remark, which I'll repeat. It seems like Mr. Market, he really likes to keep investors like Ken and me humble. It's picking off our companies one at a time. And it's no fun, but we have long-term hope. And part of doing investing with eyes wide open and sharing with friends is that you get to experience what's down at the bottom of the page. Matt Spielman, Matt, you shared this morning, and I really think it makes a point about when you're investing with friends in an investment club and actually doing it. It's a whole lot better than those paper portfolios and pretend portfolios. And you have a different feeling about investing in general when you're actually investing regularly. What are your thoughts?
Yeah, Taleb does not hold his thoughts back. He's a very blunt and direct speaker. He names names with some very prominent economists and personalities he disagrees with. But in this case, and it's only in the second edition, it's in some additional chapters he had. He is specifically targeting, I'll say academics, but people who are more involved in commenting on other people's decisions than doing them alone. And he started I mean, he always has had an academic interest in a number of areas, in philosophy, in poetry, and music, and in addition to decision making. But he was a practicing trader, options trader,
Right.
and so, but you know, this is the strength of your own first person experience. When people say, you know, beating the market's impossible, it's efficient, meaning in an absolute sense. All those things that aren't there when you have a stock that pops, a David Gardner spiffy pop, or something like that, and you can say, well, how can this be in their world? And if you read into Taleb's world, he has 5 books he calls the Incerto. You read into his world and understand how disconnected academic theory, particularly economic academic theory, is from real life and the messiness of real life.
Mm-hmm. Yeah, good stuff. He certainly doesn't pull any punches. He had quite a career with, I believe, Credit Suisse and Deutsche Bank, some hedge fund activity also, and he's
Yeah.
not bashful. He did get personally wealthy by betting against the markets back in 2008, as what I understand to be the
Yeah, yeah,
situation.
and yeah, that's an interesting part. So Black Swan was written in 2005, I believe. So it's about 18 months, 2 years before that. These additional chapters are sort of afterward. He gets to take a victory lap and say, "See,
Good stuff. But my takeaway is more the positive of, you know, what doing this, first of all, can be fun. It can be very rewarding, but it changes the way you saunter.
it's a defense against those CNBC alert banners."
There you go. Anything you'd like to share here, Ken?
Well, I'm going to change the subject just a bit and take you back about 10 minutes here. I had never, ever thought of these top 10 stocks as representing the rule of 5, but the more I look at them, the more I say to myself, it's almost a perfect microcosm for that rule, isn't it?
It really is.
It's just absolutely, there's 2 that are returning probably much better than we would ever expect. I just can't imagine thinking to myself 10 years ago that Microsoft was going to be able to return a relative return of 16%, you know. And NVIDIA, of course, has just been unbelievable to a lot of us in its performance. But you got those 2 super performers. You have those 2 that are kind of near the bottom, and you got the other 6 that are just basically doing kind of what you would expect at either end of reasonable. I mean, when you talk about 2% relative return to 10% relative return, that's a pretty good margin to aim into. I think a pretty good grouping to say, if I could keep myself anywhere between 2 and 10% relative return, I'm going to be happy. And I had never ever had thought of that, and thanks for bringing it to my attention, Mark.
Appreciate it. Yeah, if we're aiming for, you know, 3 to 5% relative return, it's really cool to end up with Fastenals and Googles and Visas that deliver that, you know, over the long term, or have delivered that. So we'll
Well,
continue.
and we've been telling clubs, Mark, for years now. Don't be shy about trumpeting your 2% relative return, because that's a superb return in and of itself. You know.
Absolutely. Yep. And anybody trying to run a public mutual fund certainly relates to that. All right, and we'll take a look at that here in a few minutes. So here is at the half, plus 3 days, the Groundhog Standings, and we'd have Kay Light back on top. She has sprung back up to the top with her 45% return over the last 6 months. And Marcia, there's Golden West in the number 2 slot. We remarked it's been a while since we've had a club at the top of the standings, and you're certainly a threat to make it there, along with 5 other clubs that are in the top 20, including 3 multi-year champions amongst those 6.
And just when I thought that Bauer City was going to be moving down the list again, they had gotten up pretty high a couple of different times. Here they go, jumping back up to number 6 again, Mark, and that's
Yeah.
a 3-time previous winner. That group of women out of Janesville. So more power to all these clubs that are in the tops up here. I don't see any of my clubs in the top 50. So
Yeah, there's a
uh,
couple Michiganders on the list, but there's quite a few Michigan clubs between 50 and 100 for sure. So they're in there.
So I want to know who's responsible for the Breakfast Club entry, Mark, because what I hear from these Breakfast Club guys is that they're not that good of a stock picking group, but here they are at 31st place right now.
Well,
So they must have somebody that knows what they're doing.
well, last year Steve Emmerich took the lead and basically put their entry in, and let's just say that his contribution this year was minimized, and that is a group of 8 to 10 contributors to that list, led by Dave Roberts down there. So good stuff. I'm going to pay the price for this tomorrow morning, by the way. But
Yeah, I do want to call out the motivated investors, Mark, because they were
yes,
one of the clubs that was so disappointed when Mid Michigan finally stopped doing its own contest, and so we took special pains to get them involved in the Groundhog contest, and they've just been performing like nothing here. 20th last week, 27th this week. That's a group of very savvy, newer investors that are just learning the ropes, and boy, they seem to have learned the lessons really well, really quickly.
absolutely. And our friends Bill Griffith and Betsy Wills and others are lurking at the top of the list. Those of you that are wondering about Steve, I think the name is Koch, Steve Koch at number 10. Um, they were left off the original list, and I have the receipts, so I missed them. So that's why they appeared out of nowhere and ended up at number 10. So a legitimate, valid entry. And I'm going to try to cook up my own email and backdate it and send it in so that I can fix my own results. But
Well, I'm just looking for the rest of the knights and the damsels on the list here. Where are you guys? Come on, let's get these entries in there. Let's do some thinking here. All right.
there's a number of people on here that we claim as being in that community. Anyhow, the pretty spectacular performance for 6 months, considering that the market is up 5% over that time frame. And the way that we invest, all of the above investing is down to minus 1.5 that you see here. So again, do a victory lap. And Ken, of course, is elated that the monkey is threatening to hit the bottom of the trench. And he does wish ill will upon the monkey.
Yes, I do.
All
the
right.
only entry in the entire contest that I wish moves down the list.
All right, here's a look at a topic or a theme that I thought we might kick around for just a minute, by courtesy of Mark Hulbert at Market Watch, and he's just pointing out that the Russell 2000, which is basically a group of smaller companies or damaged companies that are in that smaller capitalization list, and typically smaller companies, we chase them every year for Halloween with the red rabbits. By the way, although Ken doesn't want me to mention it, I think our red rabbits for our best small companies for 2025 are up, beating the market by 10 to 12%. That of course will go down now that I said it. But the reason we do that
You
is
didn't learn from 2 years ago, huh, Mark? Okay.
it's on full display here though, Ken. I mean, on the left side of this chart, you notice how that the red area is pretty hot compared to the S&P 500, which are all large companies basically. And on the right-hand side of the chart, you can see that that is kind of an unusual lag for the rabbits versus the large companies. And it's just a weird market to me. In fact, we had a weird result with a roundtable where a bunch of our companies that are just the one-time selections have actually improved pretty well, but the overall portfolio is just kind of still lagging a bit, and it's just kind of a weird market condition. You've got your Portillos out there dropping, 20% before lunch, and they're not alone. Other companies that are taking off and doing pretty well. So it's a, I would say, a somewhat bifurcated market, but I continue to have great faith in the smaller companies.
Mark, I don't even know if I want to ask you this question that Robin Hamilton is asking in our audience, but
Oh
she
no.
wants to know. She wants to know on the dashboards that are on the public website, the unofficial dashboards. Are we going to start to see some of the ETFs and mutual funds fill themselves in as we move towards the end of the contest?
We will. I can't say when, but we have already started that process. So yes, that will happen. If I had to throw a number out there, I would say within the next 3 months, we'll see a lot of those uncovered holdings get covered. So we'll continue to hope for that. We have some development efforts in the works that are going to deal with a lot of that stuff. So yes, Robin, we will as soon as we can.
Well, I will give Robin and everybody else in the audience a little bit of a hint. Those dashboards with the number of shares on them are pretty accurate with everything that is already covered. And the number of shares is not going to change between now and the end of the contest. So what you can do is, if you have an uncovered one, and I've done this because my entry to the Groundhog contest contains an ETF. And so what I did was I found the price at the beginning of trading on February 2nd. I figured out how many shares I would get of that ETF. I put that into a portfolio, but not a portfolio that's being tracked on Manifest, where the mutual fund, where the ETF's not covered, but I put it into a portfolio on my Yahoo, and now I'm able to see my portfolio to the dollar, and I can then compare it to what the rest of them look like and see within 2 or 3 spots of where I am at any moment of any day. I find I don't take the time to do it, but I can if I want to, and it makes me feel good. So, so that if you're really, really looking to get to the penny, you can do that, and you can place it in a portfolio that tracks the entire market and would include all the mutual funds and ETFs on a regular basis, and you can get your value that particular way then.
I will say that people do have a lot of fun doing this. We appreciate your participation and your courage in doing so. And I do think that we will get a broader visibility within the better investing community between now and the end of this contest. And I suspect that is going to require that we fully automate the listing that you're seeing on the right is 100% fully automated, and it accounts for dividends and splits and all that stuff, and current pricing. It's real time, so I suspect that 6 months from now, I can't promise it, but I wouldn't be surprised if that's not more robust for the year ahead.
Hear, hear.
All right. Well, speaking of things that we really need to get our arms around, I know you guys get tired of hearing this macroeconomic stuff, but this continues to be a table to be pounded upon by Brian Westbury at First Trust. And I think that informed investors are important, and especially when it comes to economic issues. So did George Nicholson. And in this case, most of the stuff you read or hear about in the news is just wrong. Most of it is a charade, and really the only thing that affects inflation is M2, or at least it's the biggest single contributor to inflation. And you can see the big surge in the money supply, known as M2, back during COVID. And there you see the federal funds rate down at the bottom of the page, and they're really not that linked. There is linkage, but not that linked. So when they talk about the Fed changing interest rates to try to affect inflation, that's not the predominant factor. And so, again, I don't want to harp on this, but I do think study this, study what Brian says, take a look at those two pictures, and try to come up with a different conclusion. I don't think you'll be able to,
I
especially if you
think,
dig
Mark,
deeper.
it's very interesting. I've done a class over the last 20 years on the 10 lessons that George Nicholson put together and talked about that caused inflation and what inflation could do to the stock market then. And Nicholson did not put two different types of impetus into inflation. One of them comes from the printing press, and that's the kind of impetus to inflation change that Mark is talking about with the M2, with the money supply, because the federal government has the ultimate authority to print as much money as it chooses to, and that probably has inflationary tendencies. But the other academic theory is that the Fed can control inflation with interest rates. And Nicholson was not really sold on that particular argument. And it seems that this data is not there to sell us on that particular argument either. It's showing virtually no inflation when the M2 supply was being held consistent. And it doesn't seem to pertain very much to what the Fed was doing with interest rates over those periods of time. It would behoove us all to go back and maybe review some of those lessons that Nicholson talked about in what inflation will do to the stock market and to PE values within the stock market, because that's what we can take away as investors when we're trying to wade through all this macroeconomic theory.
Absolutely. And I'll probably stick the results of the more recent polls. I do think we are going to finally see an interest rate reduction, possibly in the next month or two. And that's not going to kill us inflation-wise. All right, a week from today, we will take a look at the Buttonwood portfolio. I'll probably convert this into a chart between now and then, but this is one of those things which we began throwing up there, and I think looking at this from when we first started doing it, the Buttonwood portfolio and the progress over time, it really underscores what we're trying to do, and that is keep the portfolio return forecast, known as the projected annual return, the weighted projected annual return of all the holdings in the portfolio. And these two things work together. There's $100 per month flowing into Buttonwood with a couple of exceptions. Those exceptions being when my wife thinks the market is way undervalued and she throws more money at it, as a good investor should. And again, keep that par up, and that future value 5 years from now just continues to make steady progress, even when you might lose month to month. So.
What is very interesting to me, Mark, is that a chart like this maintained over a long period of time, we can start to look back then and see how accurate some of our projections were. They're not going to be perfect because the portfolio will change the components over time as well. But this is giving us data that will be very helpful, I think, as we move forward. Remember that none of those numbers in the columns 3 and 4, the second two columns, none of those have happened. Those are all projections, and we'll see how valid those projections are when 5 years passes.
Absolutely. Here we go. Here's the look at the portfolio, and we'll be wrestling over where to invest our $100 in cash a week from today. I have my notions about where I think it belongs, and Ken probably has his, so we will debate and make that decision.
Let me make a comment, because I do belong to a number of investment clubs, and the most difficult problem that my investment clubs are having is finding enough candidates with a strong enough sales growth rate and a strong enough potential return to want to put more money into. Either it's already too large a position in our portfolio, we don't want to put more money into it, or the sales growth rate is subpar, or the par is subpar. And this portfolio presents many opportunities for a really great discussion on where we can drop this $100. And what's nice, there's probably 6 or 8 logical places to drop it.
Mm-hmm. And then there's Mark's idea. Beyond those 6, but yeah, I'm completely with you on that, Ken. I do think at some point we want to talk about why does everybody hate Novo right now. I just don't see the change in their field of opportunity that many people do, and might be time to have a GLP-1 discussion. Maybe I can drag McManus in for an update on some
Well,
thinking.
except for the fact, Mark, that they seem to have lost protection by not filing some paperwork on time. And I
Yeah.
think that's the one thing that right now that you can't get past. They messed up, and it's going to cost them some protection from competition. And I think that's one of the big reasons right now why people are really hesitant about dealing with what might happen to the company. It's all conjecture going forward, but there was an error made and admitted by the company,
Mm-hmm.
and I think that certainly should have cost somebody a job. But it also probably cost Novo a couple of points of profit when the whole thing is said and done.
Yeah, and they have new leadership too, and I get all that, but again, is it that overreaction thing? I don't know. Time will tell, but we will be taking a look. But in the meantime, Ken continues to revel in IES and EXL and some of those other companies. And yes, Kevin, we still have our Western Alliance. Okay.
IES is going to be presenting us with an issue, Mark, pretty soon with that 5.7% par. The run up in that company has been dramatic, and that's what causes the decline in par as the company runs up faster than you expected. So we're going to be talking about IES maybe in the next 2 or 3 or 4 months if it keeps running for a different reason than all the other stocks in there.
I do expect the analysts to ratchet up some expectations, so maybe they'll take some of the heat off.
I would hope so. I would hope so, yeah.
All right. Just a real quick thought here. David Gardner, the Motley Fool, we've talked about them a number of times. His brother won the celebrity Groundhog entry last year. That's Tom on the right down below there. Thought this cover was kind of interesting back from the mid 1990s when we first became aware of them and involved with them. And David's had a pretty good run. The reason that I wanted to bring it up here today is he has written another book about his rule breakers, which includes a number of categories, including that early stage investing. You can see the names here down at the bottom in this description. The early days of NVIDIA, Netflix, and Amazon, Tesla. A lot of these are very challenging for many of us to become interested in earlier. And he basically goes through and explains that in the book. He describes it as almost spiritual, an epilogue, a spiritual epilogue. Probably the last book he will write, but sharing lessons of a lifetime of investing. Tom and Dave became interested in investing with an investment club that their father encouraged them to participate in. And I just think it's a wonderful story. I'm certain we'll be taking a look at this when the book comes out in a couple of months. And good, clean fun.
I would ask our audience, Mark, to maybe in the next couple of months, nominate some stocks that are on today's market that they might consider to be rule breakers. I know we've had some discussion in the forums about a couple of different stocks that people feel don't fit the investing mold as we normally invest in as growth investors at a good price. But I would encourage our audience to send you or me candidates for what they think are rule breakers in today's market. He's given us a great list of rule breakers, and I would imagine that most of these rule breakers have become stocks that many of you own today, that at some point they cross the line from being a rule breaker to being a good, consistent growth stock, and you've put money into it. I know that I own 4 of them out of the list right there. So,
Yeah, we have Amazon, Starbucks, Netflix, Booking, Mercado Libre. You and I were both fairly early on, and a tiny bit of Tesla. So those are sure to go down in price tomorrow. So everybody out there be ready to buy when they all dip. Know that I admitted to owning them, but good stuff. Yeah, so that's a great suggestion, Ken. We hadn't talked about doing that, but yeah, bring out your rule breakers, and I'll throw one on the pile. Palantir.
well, that's the one I have in mind because I actually put money into Palantir about 4 months ago, and now I have no idea what to do with it.
I
I,
think I
I wisely put it in a tax deferred account, but I'm not quite sure what to do with the darn thing right now.
so
It's behaving so well.
What does that do to your portfolio average PE?
yeah, I was going to say, Ken.
Well, it really messes up any kind of a dashboard. I'll tell you that, Matt. Okay.
So Ken, does when the discussion of Palantir and the PE, which is probably, I don't know, 800. Again, I'm not suggesting that PE has any validity whatsoever, but the PE might be 800. Do they make you stand in the hall and during the meeting or what?
Well, Mark, I took to heart the advice that said I can play with a certain amount of my money.
Oh, okay.
So I was playing with that. I also own, and I've made no excuses for owning Oklo and NewScale Energy. SMR is the ticker for that one, and they have par values that are just playing havoc with any of my dashboards. I have to not include them on the dashboard to see what the par of the rest of my group actually is. So
yeah, these are interesting stocks. Your SMR, I will share with the audience. This stock does not move 0.5% or 1%. It moves 5% every day.
Or almost every day, and so does Oklo. Yes.
Yeah, but
And
some of them are -5,
well,
-5,
exactly,
-5.
exactly. And we'll add a third one to that triad, Mark, and it's that Credo Technologies.
Yeah.
Also moves 3, 4, 5, 6, 7% in either direction almost daily. So very interesting rule-breaking stocks, no doubt about it.
This is a great topic. We've talked extensively about a number of these, including Netflix, where you had to really grit your teeth to continue to be an investor in Netflix a number of times. And if you did, it's just an amazing story. Nvidia too, for that matter. So make the same case for Apple.
And Starbucks has had its moments as well, Mark. Moving down to places where you just couldn't believe that you're seeing the right price for the company at various times, and that's been within the last 3 or 4 years. So
good stuff. So we'll continue to look at that. Well, I was not familiar. I know the Motley Fool exchange traded funds, ETFs. I didn't know this one. They have an ETF by the ticker TMFE, and that stands for Motley Fool Capital Efficiency 100. And what they're basically trying to do there is take the top 100 as their universe and cherry pick the companies that have a high capital efficiency score, which is defined on the right there. Sounds an awful lot like the stuff that we look at. And then I was curious, well, how does that compare to the performance of their top 100 So I put it next to it, and this is good. It's not great, but it's a good performance, but it's not even as good as the whole 100. So we'll add it to the funds that we're watching, but
Yeah, and
it's
the only caveat that I would make, Mark, is remind yourself when you're looking at charts like this that if the dates of the beginning of the race are different, then that might have a lot to do with where the race ends up.
mhm,
And the Motley Fool 100's beginning of the race is 2018, and the Capital Efficiency ETF is 2021. So be very, very careful when you look at charts like this and don't make a direct comparison. It's only there for informative purposes. That
right.
2021 really changes the landscape of what we're looking at here.
Yeah, and Ken makes a great point. That's why we look at the benchmark return over those different periods. You can compare relative returns. You can't compare absolute returns, the returns in this column,
Right.
because that's what Ken is describing. But you can do it here. That's why we do it. So interesting. And the other one that has really popped that we have talked about a number of times, we will certainly be returning to it. It's Ken's friend Tom Lee on CNBC, who is now on there a few times a week. That fund has really come out of the gate strong, Ken, and it is a source of ideas. I suspect it could be a source of some of those candidate rule breakers also.
And again, notice the benchmark return during the time period that this is talking about. This is a very, very new ETF, and therefore it's going to move all those numbers are going to move very quickly as the markets change, either up or down. So just be aware of where the race is starting every time you're looking at concluding numbers for anything.
Hmm. Yeah, it's been around about since our best small companies for 2025. I think we're beating them, Ken.
Yeah,
I'm,
well,
I'm sure we are. That's all I'm going to say. Shh. Enough for now, Mark. Shut up. All right. All right, let's go ahead and okay, I think we'll keep the session short as we relaunch here today. I did want to remind everybody that we've been away for a few weeks, but all of the sessions over the last many years are available on youtube.com. If you search for Manifest Investing, you can find this page, getting some questions from some of the fairly recent ones, a few attaboys along the way. But you can go ahead and listen. This one is turning out to be a pretty popular one here with a number of views. And I can remember when those views were in single digits or low double digits, Ken. So again, we thank you for checking things out. If there's ever a stock mentioned, and I think we'll demonstrate this during either next week or the week after that, you can actually search on this YouTube channel for tickers, and you can actually be taken to, based on searching for a ticker, taken to the specific presentations made on those individual stocks. And it's pretty simple to do. And you can go back and find some humility in the stocks chosen 10 years ago. So good stuff. And then, of course, just a repeat of Burt Lake and I still think I should get some type of advertising award for this picture, but it hasn't, it hasn't come yet. And with that, anything in the hopper, anything that you guys would like to talk about?
I think that basically we've kept up to date. We've had a lot of comments, but we've talked about all the comments that had any thing we could talk about in them, Mark. So I think it's time to say good afternoon and see you next Tuesday.
All right. Thanks, Ken. Thank you, Matt. And we will be in touch.
Yeah, good afternoon, everyone.